Welcome back to the Deep Dive. If you are tuning in right now, you are watching the financial world. Well, transition into a full-on risk-off environment. The session we saw yesterday was one of the toughest for the market since April. And the pain really didn't stop at the closing bell. It's just continued to cascade across global assets overnight.
That's absolutely right. And our mission today is to, give you a shortcut to understanding this chaos. We're going to unpack the three interlocking reasons for this global turmoil, because this isn't random. This panic is driven by some very clear structural fears about valuation, about policy, and just deep, deep uncertainty.
Okay, so let's unpack this. The core problem, from what I'm seeing, it really started with a highly targeted sell-off in U.S. technology stocks.
Yes. Specifically those high-flying AI superstars. And then you layer on top of that a newly hawkish Federal Reserve. I mean, they've just essentially vaporized any hope that was left for a December rate cut.
And the third factor, that's the one creating the immediate volatility, right?
It's the uncertainty. Look, the end of the government shutdown was supposed to be a relief, but instead it's just unleashed this massive backlog of delayed economic data. And all of that is set to drop today, starting at 8:30 a.m. Eastern. It's creating just intense, concentrated uncertainty for every single trader on the floor.
The shockwave on Thursday was, it was brutal. The Dow shed nearly 800 points, S&P sank 1.7%, and the tech-heavy Nasdaq fell 2.3%.
But here's the most telling detail for you. The leaders of that massive bull market.
NVIDIA, Broadcom.
Exactly. NVIDIA down 3.58%. Broadcom slid, 4.29%.
Yeah.
They became the leaders of the bear market, all because of concerns that their valuations were simply too stretched. And that targeted U.S. selling. Well, that immediately set the tone for the rest of the world.
So let's talk about that global contagion, the AI hardware panic.
The contagion was instantaneous. It just flowed straight into Asia's overnight session, tracking the U.S. route move for move. The Nikkei 225 in Japan closed down 1.8%, led lower by tech names like SoftBank, and the Hang Seng in Hong Kong lost about 1.9%.
Meanwhile, the Shanghai Composite down 1%. It had its own internal problems amplifying the fear, didn't it?
It did. China's factory output grew at a 14-month low. It came in at 4.9% in October, which was a significant miss from the 5.5% expectation. So you've got global growth fears just layered right on top of their own slowing domestic momentum.
Okay, but you said there's a critical signal in all this. The one thing to watch for the AI trade.
Right. If you want the signal for what is happening to the structural foundation of the AI trade, you have to look at South Korea. The KOSPI was the region's biggest loser. It plummeted a massive 3.8%. And this wasn't just general panic. This was a surgical strike. It was focused on the entire global chip sector. And that confirms the fear has moved beyond, just software valuation. It's now targeting the fundamental hardware valuations underpinning the entire AI infrastructure.
That structural fear is a key point. How rare is it to see a surgical strike that's this coordinated? Hitting fundamental hardware suppliers like SK Hynix.
Oh, it's highly significant. Samsung Electronics was crushed, down 5.5%. And SK Hynix, the crucial memory chip supplier for AI, it was decimated. It lost 8.5%. When the memory chip suppliers, the guys who literally provide the building blocks, are hit this hard, it tells you the market is fundamentally questioning the expected growth rate of the entire AI hardware boom.
That gives us a really clear signal. So moving over to the European session, they naturally followed that macro lead. Frankfurt's DAX is down about 0.7%. Its own tech names are under pressure. But the UK's FTSE 100 is faring even worse, down 1.1%.
And the UK is suffering from the global macro pressures plus a unique internal vulnerability. We're seeing a substantial sell-off in UK government bonds, or gilts. And this was triggered by reports that the Chancellor scrapped plans to raise income tax, which, well, it immediately raised serious concerns about the stability of the UK's public finances. So in London, you have that macro contagion mixed with internal fiscal worry. It's creating double the pain.
And yet in all of this, we have to mention the one massive outlier that just defied the chaos.
That would be Siemens Energy. They are surging, 9.3% in Frankfurt? And that's based purely on company-specific strength. They reported strong Q3 results, they raised their midterm targets, and maybe most importantly for investor confidence, they announced their first dividend in 4 years. It really just proves that fundamentally strong companies, if they deliver, can absolutely defy the broader gravitational pull of macro pessimism.
Okay, let's pivot to the second major catalyst here, the Federal Reserve. The market was, I think, desperately hoping for a narrative change, something leading to a December rate cut. But that hope seems to be completely evaporating.
That's the reality now. We heard it clearly this week from Fed officials all across the spectrum. Susan Collins in Boston, Beth Hemick in Cleveland, Alberto Musalem in St. Louis. The message is unified and it's loud. They see absolutely no urgency to ease policy, not when inflation remains so sticky at these levels. The market has been forced to accept this higher for longer narrative.
And if the hawkish talk wasn't enough, we had the end of that 43-day government shutdown, which has proven to be a classic buy the rumor, sell the news event.
Well, the genuine problem created by that shutdown is that the market and the Fed, they've been essentially flying blind for 6 weeks. They've been missing all that critical inflation and activity data.
And that brings us to today's high stakes.
Mm.
You need to circle 8:30 a.m. Eastern on your calendar. That's when the new data deluge begins with the release of the Producer Price Index, the PPI, and U.S. retail sales. We've seen soft economic data get ignored before. Is the PPI really the key here? Or is the market just using this data delay as an excuse for the tech sell-off they wanted anyway?
No, the PPI is absolutely the key. Because it's a direct wholesale measure of the cost structure that underlies that sticky inflation the Fed is fighting. So let's just look at the scenarios. Scenario 1, PPI comes in hotter than expected. That immediately cements the higher for longer narrative, it sends yields soaring, and it almost certainly triggers the next major leg down in equities.
And the flip side, what if it's soft?
Well, scenario 2. If PPI comes in soft, it might offer a moment of relief for equities, sure. It weakens the inflation narrative. However, that immediately amplifies fears that the economy is slowing faster than anyone thought, which just substitutes an inflation fear for a recession fear. So essentially, the market is set up to lose either way today. That's a very tough spot for traders to be in.
We also need to watch the Fed commentary, right? The discussion doesn't stop with a data drop. We've still got a flurry of Fed speakers today. Raphael Bostic is speaking twice, I think, and Schmid, and their comments are going to be parsed against whatever the morning data reveals.
All right, now we have to step into the market's engine room and look at the biggest contradictions. Because this is not behaving like a textbook risk-off event. The safety nets are failing.
Okay, what's the biggest warning sign you're seeing in the bond market?
It's the 10-year Treasury yield. It's holding firm at 4.12%. This is the most bearish contradiction this morning. You see, in a normal equity panic, investors flee stocks. They rush into the safety of U.S. bonds. This rush drives bond prices up and yields down. It's a mechanism, often called the bond market put. It acts like an insurance policy for stocks.
And right now, that insurance policy is completely failing.
Precisely. The bond market is completely ignoring the equity panic. It is singularly focused on the opposing force, sticky inflation and the hawkish Fed. It's refusing to rally alongside the equity sell-off, which signals the complete loss of that traditional bond market put. There is no safe harbor right now.
Now look at the dollar index, DXY. It's at a 2-week low around 99.15. That feels, well, fundamentally counterintuitive for a global panic. Capital should be flooding into the dollar.
It is. It's a clear tug of war. While the global flight to safety should be pushing the dollar higher, a domestic speculation trade is holding it down. Traders are aggressively front-running the potentially weak U.S. domestic data that comes out at 8:30. They're betting that those reports will eventually force the Fed to ease. So they are selling the dollar now, expecting bad news to follow, and that's overriding the typical global safety trade.
We're also seeing a clear decoupling in commodities. WTI crude oil is bouncing up, 1.5 to 2.7%. It's trading near $60.30. It seems completely decoupled from the growth fears hitting equities.
Correct. The energy market is trading on its own supply and demand fundamentals. It's not currently pricing in a catastrophic global growth scare. Meanwhile, gold is consolidating a bit, trading between $4,165 and $4,175. It's taking a breather, which is a sign of profit booking after its recent highs. But it remains structurally bullish as the ultimate hedge against both inflation and geopolitical uncertainty.
And finally, the fear gauge. The VIX closed Thursday at 18.04, and the futures are trading significantly higher. That confirms a very tangible rise in investor anxiety. The cost of portfolio insurance is definitely soaring. You know, even on a day like this, we always see some truly bizarre moves. The Cidara Therapeutics mystery is, it's intriguing. The stock, ticker CDTX, is exploding. It's up 91.25% to over $200 on massive volume in the pre-market.
And here's the key insight. There is absolutely no new press release, no SEC filing this morning. Cidara Therapeutics, they're a biotech focused on developing treatments for infectious diseases, and they have had a string of major fundamental positive news lately. I mean, an FDA breakthrough designation, a phase 3 trial initiation.
So if the news is old, What's causing the 91% spike right now?
This is highly likely a massive short squeeze. It's being triggered by those previous fundamentals or possibly a new, extremely bullish analyst initiation report that's circulating privately. It's pure momentum hitting thin liquidity, and that's driving an exponential move based on recent, solid underlying facts.
Now, on the flip side of that, we have to issue a critical warning on lazy days. Ticker GORV. It's up 26.6%. This just feels like dangerous speculation.
It is a massive red flag. Investors need to listen very closely to this. This is not a fundamental recovery. Lazy Days is selling substantially all of its assets. They're planning to delist from Nasdaq, citing substantial operating losses. This is a liquidation story, not a growth story. This is the kind of low float anomaly where retail investors, especially in chat rooms, can confuse high volume with a genuine comeback and get seriously burned.
And finally, we're seeing some targeted losses in quantum computing stocks. QUBT is down nearly 10%.
Why the specific pain there?
It's classic pre-earnings de-risking. QUBT is confirmed to report earnings today. In a hostile tech environment where investors are already punishing stretched AI valuations, traders are simply not willing to hold a high-beta speculative tech name into its earnings report. They're getting out ahead of the news, anticipating a cold reception for any weak numbers. So what does this all mean for the actionable technical levels? Looking at the SPDR S&P 500 ETF, or SPY, the bias remains firmly to the downside ahead of that 8:30 a.m. data.
That is the path of least resistance. And the most important technical battleground for the entire day is the critical support level at $660.64. This is not an arbitrary line. This is a highly active level where a large number of investors recently established positions.
And why is that accumulation point so important?
Because if the SPY breaks and closes below $660.64, all those investors who bought there are instantly underwater. That scenario triggers automated programmatic selling from algorithms that are programmed to respect those volume clusters, and it would likely accelerate the current sell-off dramatically.
Okay, so if we somehow get a relief rally from soft 8.30 data, what are the resistance areas we should watch for sellers?
You'll hit your first pivot point around $679.83. But the hard ceiling for any potential rally today is near $685. And this level corresponds to a major option gamma level, so think of it as a defensive line. Market makers holding massive option contracts at that strike will actively sell futures against the level to hedge their books. And that effectively creates a cap for the rally.
So to summarize for you, the SPY closed near $672.07. Your primary downside focus is that $660.64 support level. That's the panic trigger. And your ceiling for the day is the $685 gamma cap, where the professionals are waiting to sell.
Right. To synthesize everything we've covered, the market is in deep distress. It's due to that triple threat, the structural unwind in AI tech, the newly hawkish Fed, and the deep uncertainty around the incoming data. You have to focus on the 8:30 a.m. PPI and retail sales reports, and you have to watch whether the $660.64 support level on the SPY can hold the line against automated selling.
And here is the provocative thought we'll leave you with. Despite this overwhelming global risk-off cascade and the hawkish Fed, we are still seeing moments of intense selective strength. You've got the resilience in the oil market, the strong fundamentals driving that 9% surge in Siemens Energy. The question you should be mulling over is this. In a market defined by macro pessimism, can fundamental company strength continue to defy that broader gravitational pull? Or is this just the calm before a deeper, more uniform storm? We'll see you for the next deep dive.